Well, hello, everybody. Welcome to Economics. Today, we have a very special guest, Dennis Stearns, who is the CEO and the founder of Stearns Financial Group, which is a billion-dollar plus money manager. And he's going to discuss something that's very important to all of us that are watching here and around the world, the economic forecast of 2022. So I had to reach into the corporate bag and say, who knows what's going to happen in 2022? It's not moi, but I actually heard Dennis a couple of years ago do a presentation. I said, well, we have a guru that actually can predict the future. So I'm bringing him on. And with that, I'm going to turn it over to Dennis, and he's going to show the what's going to happen in 2022. So, Dennis, the floor is yours.
All right. Thank you, Nick. And so the title of this is Sailing in Uncharted Waters, which by definition means that there's a lot of potential scenarios. So I don't know about the guru piece. Let's move right into a couple of our slides here, a little bit about our background as a firm. And we do a lot of working with thought leaders in the United States and around the world on many different topics. And so I'll try to weave some of that into today's conversation. Next slide, please. So here are some of the top ideas for investing. Number one on the hit parade, the U.S. Federal Reserve, as they say, don't fight the Fed. And it's indicated they will be normalizing policy over the next several years, although it's unclear that normal will actually be back to pre-2008 normal. So the question is, can they thread the needle without roiling markets or making a misstep? Just a reminder, the fourth quarter of 2018 was a really bad quarter for the S&P 500, and it was caused by conversations by the Fed about raising interest rates and some other policy moves they were going to do. Not that they actually did it, just that they might be doing it, and that roiled the markets. Well, now everything has been telegraphed, and so there's a pretty good understanding that the Fed is going to be raising interest rates probably 3 times this year, a couple times in 2023. And even then, we'll only be back to where they were at the beginning of 2019 with interest rates. So I don't think we're going to see a lot of markets get upset by this, but you just recently saw that the Fed said, well, we may accelerate that a little bit because of inflation, and at least temporarily for about 3 hours in the stock market, there was a little bit of an upset stomach. So expect to see a few of those issues. We do expect our number one forecast is volatility will increase in 2022. And that's not a tough forecast because 2021, we only had 5% downtick in 2021, which is very rare. Number two, bonds are at a multi-decade low probability of exceeding inflation in the next 3 to 5 years. Do they still have value for defense? Well, the answer is probably, but we are at one of the lowest bond allocations in our history. If you're growing assets and have 5 to 10 years or more until you're going to be pulling money out, maybe you don't need any bonds at all. But if you're in a close to retirement or retirement mode, there may be a role for bonds. We're using a lot of bond substitutes, which I'll talk about in a few minutes. Number 3, vaccine rollout, COVID watch, definitely a question both in the United States and around the world. Omicron is a problem because it is so virulent. And so just talking to some infectious disease experts over the weekend who said, well, everybody probably will get it who hasn't had it. And even if you're vaccinated, and just talked to a client who actually got original COVID, almost died, and then just got Omicron. And he said it was about a 3 on a 10 scale, kind of like a really bad cold or the flu. He is vaccinated, but he said, I wish I hadn't gotten it. So there's definitely a lot of issues here, but it burns through quickly based on our experience with South Africa and some other places in the world. And so it is likely that we are moving from a pandemic stage of the world to an endemic stage of the world for COVID in 2022. Let's hope that we don't have any bad variants that come out. Number 4, inflation has been surging. Should we be worried about our personal budgets or corporate earnings? The answer is yes. However, maybe not as worried as the media would want us to be worried. And so inflation, we do hundreds and hundreds of budgets when we do our financial roadmaps. And in that financial planning, we have found that most people, the way they spend money, only 30 to 40%, sometimes as high as 50% of their budget will be subject to high inflation rates. And the rest of their budget is subject to moderate to low inflation, and in some cases, even deflation. So again, the question is, how do you spend money? Now, we have seen a lot of lifestyle creep where people are so fed up with the pandemic and want to get out there and normalize their life if they can. And so when they go traveling, they will want to do maybe a 4-star hotel instead of a 3-star, or they will want to upgrade some of the things that they do. Well, that's a form of inflation, but it's not the one everybody's worried about right now. But we see that across the board in a lot of our clients. Corporate earnings, this has been a real concern in the last 90 days, particularly U.S. companies, although many international companies as well. The question of inputs to their supply chain and inflation and all of that would bring corporate earnings down or profit margins down. Well, lately we have seen less worry about that. Now, just last week, Bed Bath & Beyond had a disappointing earnings, and they blamed it all on the supply chain and inflation within their supply chain. So not every company is immune to this, but the good reminder that transnational companies, wherever they're located around the world, have a lot of workarounds these days. And those workarounds they are using at an unprecedented level. Number 5, an environment of low interest rates, modest inflation does justify some higher stock valuations. How long will it last? Well, the answer is maybe longer than many people believe. We have run some scenarios where if interest rates somewhat normalize in the next 3 to 5 years, we're going to have anywhere between 15 and 25% compression of valuations. So in that environment, earnings increases are even more important than normal. And the good news is that we're looking at somewhere between 8 to 12% earnings increases in the US and many parts of the international overseas markets for 2022. Then we think it'll settle back to more of a 6 to 8% kind of range, kind of normal range for corporate earnings growth. Well, if you work the math over 3 to 5 years, that will offset some or all of the valuation compression. But it is going to be a much rougher sledding time, particularly for the S&P 500 in the next 5 years. We still think there'll be positive real returns over inflation, but there will be more of those 5 or 10% corrections each year. So occasionally it will require some Dramamine. Let's move to the next slide. So number 6, many international companies remain below fair value, have better return prospects, and better dividend yields. And so the question is how much to allocate? Well, we believe that those international companies, blue chips in particular, emerging markets are a little different story because they've had some other issues they're dealing with, and largely unvaccinated markets, ex-China. But even China's now suddenly trying to figure out how to deal with Omicron. I think they'll probably deal with it fine, but it's going to, again, create some roiling of their markets for supply chain. Everybody should remember that many companies, Tesla, Apple in particular, doubled down on China as a supply chain source, wherein a lot of other companies are trying to move supply chains out of China. So at any rate, the international stocks, how much to allocate? Well, David Swenson, the famous Yale investor, he actually has an overweight to international blue chips to US. The ACWI index, world index, is now about 60% US, 40% international. That's where we think it's reasonable. But again, depending on your circumstances and whether you're an aggressive growth investor or not, maybe having some more in that category would make sense. For US, our audience, if you're worried about weakness in the US dollar because of a lot of things going on in Washington, D.C., having unhedged international holdings is a plus and will actually give you a tailwind on returns in addition to what we think could be decent returns to begin with. But just a reminder, number 7, the U.S. remains a very strong hub of innovation. Again, some of our international friends might debate whether it's 15 out of the top 20 research institutions, universities, or 18 out of 20. But the fact remains there's just a lot of very strong innovation in the United States, the techno-industrial revolution benefiting many of the big tech and smaller companies in tech, and tech-enabled companies that are doing things the old-fashioned way, but they're upping their game with technology, automation, artificial intelligence. We should all remember that COVID, the pandemic, we saw a massive amount of acceleration of what were already trends in motion. And one of them is the technology accelerator piece. So some of the experts in the space have said that we've had 20 years of innovation in the first 20 weeks of the pandemic. And certainly in a lot of different areas, things have been accelerating. So again, the US stock market, I think still is a reasonable place, but valuations are higher and there's some things to worry about there. So how much to allocate? This would be a great time to be looking at winners and possibly taking some of those chips off the table and moving them to some of the areas that haven't been as strong in 2021. Now, the other piece for the U.S. stock market, I usually say if stock returns have been very positive, you should send a thank you note to the Federal Reserve, who often is a reason for higher risk assets getting more capital, or you should send a thank you note to the company leadership because maybe they've done some good things to increase their earnings, increase their marketability as a company. Buying back stock, some people would say that's lazy management, but it's actually effective in terms of shrinking the number of shares and increasing earnings. 2021 was actually a year where you should have sent the thank you note to the folks in Congress, the lobbyists for Congress in the United States, because the lobbyists actually took corporate taxes out of the equation. Now, the second reconciliation bill, not even clear that's going to pass in 2022, but 6 months ago, there were proposals to significantly increase corporate taxes in 2022. Then those were diluted. Again, corporate lobbyists were a major responsibility for that. And then they were spread over a period of years. Had that not happened, we suspect U.S. returns would have been much lower last year. Number 8, private real estates, real assets, well managed in good growth areas remain a very good core asset. Now, private real assets could be real estate, but income producing real estate, but it could also be agriculture, timber, infrastructure. Toll roads are the new bonds. And so there's quite a few ways to invest in things that actually have pretty good history of hedging inflation, have low volatility, and certainly better real return potential looking out the front windshield than bonds do. And then finally, many alternative assets like private equity and venture capital are in a sweet spot. Many of those things were not available until recently. They were not available to folks under $5 million of portfolio net worth. Now, some of those things are coming downstream. To get into most of them, you still need a couple $1 million, but there's quite a few places that you can actually get into individual venture companies and do it for $5,000 or $10,000. I mean, you can do some of it on a few sites for even less than that. Again, I think buyer beware, make sure things are well vetted. And so who should consider these alternatives? Generally, people who have a portion of their portfolio dedicated to what we call explore, as opposed to core. Now, private equity for a lot of our clients is a core asset, but there's different flavors of private equity, many different flavors than there were even 10 years ago, from very low risk to very high risk to everything in between. All right, so S&P 500 valuation measures. This kind of shows you that we are right around levels that we saw in 1999, 2000, which again is a good reason for caution. However, this time is different. And the difference is those are strong corporate earnings to underpin it. A lot of those companies back in 98, 99, you remember that was the dot-com boom. And a lot of those companies had reasonable corporate earnings, maybe not the dot-coms, but some of the large tech companies, but they didn't have robust earnings going forward. And it took them a while to deal with the overvaluation. And so again, where we are right now, you could easily see those valuations come down, as I mentioned earlier, from 2021 times earnings on the far right-hand side to maybe 15 to 17 times earnings over the next 3 to 5 years. But we've got some good earnings that can help offset some of those. Next slide. And this kind of goes to that point that earnings are robust. And we, again, looking out the front windshield, 2022 and beyond, we believe they'll continue to be pretty good. Let's go to the next slide. So here's the 2022 earnings estimates, depending on whether you do top down or bottom up, somewhere between 8 to 12% on U.S. companies. A lot of the international companies we look at, somewhat similar. So again, I think this is the good underpinning for the market, but valuations still matter. Next slide. Global supply chains and inflation, no question, a lot of problems have been happening here. But as I mentioned earlier, there's been some mitigation of that. The big companies are finding workarounds. Many of the big U.S. companies chartered their own ships. So they had ships sitting off the coast of LA and other places just waiting to offboard products. And they decided to charter their own ships and try to do workarounds. So if you were a supply chain manager, if you were an executive trying to do all that, you probably aged 5 years in the last year. But again, never underestimate the power of a company to do workarounds. And there's a lot of that going on. Next slide. So this gets back to that U.S. versus international. We've had a long run of U.S. outperforming international companies, and that's on the far right-hand side. And as you can see, going back to 1971, it's one of the longer periods of time that U.S. has outrun international. Some of that is the big tech company that blossomed in the U.S., and they have driven, certainly the last 5 to 6 years, they have driven a lot of that. And the pandemic, normally a recession punishes growth companies and value companies do better. Well, the pandemic was exactly the opposite. It punished value companies, many of which were subject to markets being shut down, retail being shut down in 2020 for a period of time in the US and overseas. But then growth companies flourished in the pandemic. And so, again, I think this US versus international, we wouldn't be surprised 5 years from now to see this having reversed and seeing a period where you see the purple, the EFI outperformance. Next slide. And so here you get to that international valuations and dividend yields. And so it's pretty remarkable. You look on the left-hand side, the S&P 500 current price earnings ratio versus the 20-year average. And then you look at the ACWI, the global ex-US, and you have about a 14 times earnings versus the 21. And as you can see, that is a historically lower number. And a lot of folks also forget that many of these international blue chip companies have 30 to 50% of their sales in the United States. So for those of you who are the United States audience, how is that different than a US company that has 30 to 50% of its sales overseas? And in that case, would you want the one with the better valuation? All things being equal, which they almost never are, leadership teams being equal, balance sheets being pristine, and so forth. And then on the right-hand side, again, that dividend yield, probably on the next 3 to 5 years, dividends will matter more. And so you actually have better dividend yields for a lot of international companies. Next slide. Federal finances. I have a feeling that at 11:30, our next guests can talk about this a little bit. In terms of the federal finances, I'll give you my take. On the right-hand side, you'll notice that the budget surplus deficit in the upper right, that is scheduled in 2022 to come down quite a bit. It is still elevated from levels that would make me comfortable. But the fact that it's getting lower is good. Now, the effect of all the different stimulus coming out of COVID, you can see what happens going out to the year 2030, that, it gradually moves up. There are some interest rate increases baked into this forecast, maybe not enough, some might argue. And so that's, not necessarily a clear and present danger, but it's something to worry about as we get out maybe 3 to 5 years or more. Again, one of the things as a global forecast for 2022 we're looking at is the rise in debt generally all around the world. So 15, 20 years ago, we had fairly reasonable debt levels, and government debt over the last 15 years has roughly doubled worldwide. There are many countries that are now at 200 to 300% of GDP of the economy, and that's a little worrisome. The United States is not there, and you see that on the bottom right with the estimated deficits. And again, you always take this with a grain of salt, because Japan has gone for 20 years with 200% plus debt to GDP numbers, and they have not slid into the sea. They have had some issues from time to time. And so, again, I think if keeping it somewhat lower is a good thing if we can do that. And a lot of that has to do with the growth of the economy in the U.S. Next slide. So consumer finances in the U.S., this is a real positive because 2/3 of the U.S. economy is consumer driven. And so on the upper right, this is something we've watched for a long time, household debt service ratio. You can see that came down dramatically after the 07-08 Great Recession. And then it came down again in the pandemic recession, and currently is very close to its long-term low. That means consumers have the ability, if they want to borrow a lot. Consumers also have a lot of cash, and we have record amounts of cash sitting in banks, sitting in checking accounts, money market accounts. And so consumers, if they want to buy, they will buy. And the demand side of the equation, because of all the pent up demand, people are, again, kind of fed up with the everything they've had that they couldn't do during COVID, during the pandemic. And so that demand side is set to explode. I think that's one of the bigger things that will give us a tailwind for the U.S. economy and many international economies in the next 3 to 5 years. Next slide. This is a reminder that if you're a stock market investor going back for a long time, and this particular chart for the U.S. S&P 500, 32 of 42 years, you would have made positive returns. That is remarkable. That's part of the reason why so much wealth has been made in the stock market. But look at the red dots. The red dots are what you have to suffer as a stock market investor, the intra-year, meaning within a year, decline in that market. So you can have a huge decline within the year and still end up with a positive year. And if you look at this chart, you'll notice there are many years where that was the case. And so if your ability to sleep at night, because a lot of this is balancing your eat well and sleep well desires. If your ability to sleep well is affected by volatility in the stock market, that means that you may have to have lower amounts in the stock market or do hedge stock market investments or try to do something to make sure you stay in the game and don't bail out every time you get one of those red dots. Because I can tell you, if you bail out every time you hit a red dot, you are going to be a loser when it comes to stocks. Next slide. Okay, Fed and interest rates. This is what I had mentioned before, the U.S. Federal Reserve, what they're planning on doing in the next few years. And again, you look at the purple or the green on the right-hand side, what the market is expecting and what the Federal Open Market Committee is actually expecting. And the Federal Open Market Committee, again, next few years, just getting back to where we were in 2019. Not exactly historically high rates, but higher. Next chart. This is just a good reminder, as I mentioned before, to look outside of traditional asset classes. That's the benefit of today. In the old days, you had cash, bonds, and stocks, and maybe you could buy some rental homes or you could do some other things on your own. Today, you have the ability to buy into private real estate, private timberland, private infrastructure. As I mentioned, toll roads are the new bonds, and private farmland. And there's more and more ways to be able to do that and not have to have $2 million or $5 million of portfolio net worth. So again, I think as you're doing your homework, think about possibly adding more colors to your color palette. Next slide. This is Bank Credit Analyst forecasts, a lot of information here. I'll just give you some highlights. And this is their forecast over 3 months, 12 months, and 10-year forecast. So you will notice up at the very top, generally positive to neutral on equities. Bonds, not so much. So a 1 or a red means they estimate very bearish. Green is very bullish, and then you'll see a lot of neutral on this page. You'll notice the U.S. stock market is not bearish per se, but is definitely a more bearish view. So they are suggesting some underweight there. A lot of the international markets they think are a good place to be. And emerging markets, which have really had a tough go of it here lately, emerging markets are one of their top picks. I will tell you, many of the large entities we deal with, they have forecast that emerging markets will be number one in returns for the next 10 years, but they're being very cautious in the next year or two with the rewiring of supply chains, COVID risks in some of those markets, some of the problems that China is having with their Belt and Road Initiative. There's just a lot of turmoil going on within that. However, we should always remember, in the middle of difficulty lies opportunity. You get down to the bonds. Again, most of the bonds are not forecast to do great. High yield bonds, they like. Inflation protection, not surprising, they like, particularly over the longer term. And then you get down to the currencies. You see the US dollar, they are thinking over the next 10 years will be fairly weak. Even the next 12 months, they think is going to be weaker. And then you can see commodities down at the very bottom, and semi-bullish on a lot of commodities going out into the future. But again, I think we're in an environment where the demand pull for commodities, if it's things that consumers want to buy because they haven't had the ability to buy it, those are the things that will probably see higher inflation. And of course, where there's limited supply, I think that's the old definition of inflation. Too many people chasing too few goods. Next slide. So just a reminder of the some of the big trends. Everybody kind of forgets this in the middle of COVID. I already mentioned a couple of the big trends that we're looking at that are negative, potentially around debt, debt levels all over the world, the so-called zombie companies that have been able to stay afloat because they've been borrowing money. So that's on the threat side. This is on the things that will create tremendous tailwinds. So big data analytics, networked computer systems, nanotechnology. Now, again, I encourage everyone to think of the purveyors of these, and that's where a lot of the big action has been in the last 5 years. The ones who actually dream up this stuff and sell it, but the users of it, that may be where the really interesting opportunities are. The tech enabling of old factories and making them fresh, making them better automated. Next slide. Medicine, neuroscience, again, that has accelerated tremendously. It was on a briefing with the head of Moderna not too long ago, who mentioned the fact that everybody's happy with their vaccine for COVID, but they have a whole bunch of other vaccines that they're working on, and they hope to have similar kinds of success in many of those other areas and other types of drug delivery for the precision medicine area. So precision medicine is coming into its own. The next 5 to 10 years, the ability to deliver a drug directly to a cancer, all of those things are going to be huge. I always remind audiences that the pandemic has caused people to not go see their doctor as much for an annual checkup. That is critical to get annual checkups, because a lot of the diseases that are not COVID that could really kill you today, if you don't catch them early, you may not be able to mitigate the downside. So get those checkups. Energy, environmental, huge things going on there. Just in the last week, all the major car companies in America have announced some fairly major increases in their output, particularly pickup trucks, electric vehicle pickup trucks. Robotics, again, a huge one for a lot of the tech enabling companies. Next slide. 3D printing, which went through its frenzy stage many years ago, then kind of went through a bust. Well, coming into its own. A lot of companies using 3D printing. Bioinformatics, again, huge future growth area. And financial services innovation, fintech, a lot of things going on there. So again, I would encourage everybody to think about those trends, think about how they can invest in those either directly or indirectly. Next slide. And that is it for my main presentation. Went a couple minutes over, so I don't know if David has arrived yet.
He hasn't arrived yet, Dennis. Okay. I checked up on him, so he hasn't arrived yet. But what he said was pretty interesting on the international side versus the domestic side. What's developed in the United States. It looks like Facebook, Alphabet, Microsoft, Tesla, these are all US companies that have grown and pushed the S&P 500 forward. We run a show, and they might be listening in Switzerland, called Swiss Impact, doing impact investing. What are the European companies that are out that are pushing? I see all the American companies. Maybe we have an American bias here, but what are there any European companies that are even out there as far as what we're seeing in the American companies right now?
That is an excellent question, Nick. And so some of our private equity partners that we invest in are doing a number of private equity investments in European companies. They are promising, but the ones that are available in the public market are just not as prevalent at this point. There's a few companies that are coming into their own. But the fact remains that the U.S., many of the companies in the U.S. got a jump on all this and have a fairly big market share lead. Now, there's a lot of, kind of getting away from Europe, a lot of Israeli companies that have really been pushing the cutting edge of technology. Huge startup venture capital community there. But I was at a venture capital meeting with venture capitalists from all over the world, and there's amazing venture capitalists in Poland who are doing things. Now, again, are they at the level of those companies you talked about?
Right.
No, not yet. But that's the key, not yet.
Yeah.
Now, again, the biggest companies you could invest in overseas, if we were having this conversation a year ago, some of those were coming out of China.
Right.
And so we were very fortunate that our number one manager internationally sidestepped some of the China problems, but China has really been cracking down on almost every industry now, but technology in particular. And so, again, this feels like something, the Chinese, they often do things for 3 months just to remind everybody they're in power, and then they kind of slack off. But there's other things they do that are longer term and systemic and that are bigger power plays. This feels like a bigger power play. So, again, some of the really savvy international managers that we work with, they're just not rushing out to buy so-called bargains in China, but there are companies on sale.
Yeah. Oh, okay. Well, the thing is, what about the impact investing? We run a show with the Swiss Impact Investment Association called Swiss Impact. Have you seen a trend toward this impact investing? Has this become a hot button? The people in Switzerland that run it were telling me that they've seen assets being moved more and more toward impact investing and away from traditional investing. Have you seen that at all?
Yeah, absolutely. And so the amount of money, and this really started accelerating in 2019, but the amount of money that is flowing into impact investing, environmental social governance, we used to call it socially conscious investing 20 years ago, whatever you want to call it, the amount of money that's flowing into there is just massive. Right. And so that has both good points and bad points. Too much money chasing too few goods, definition of inflation. What happened was that some of those companies got overinflated in 2021, and now some of the more green types of stocks have had 20, 30, 40% downside corrections. That doesn't mean they're going away. It just means they got a little bit ahead of themselves in terms of valuations. The things that we like a lot, we like supply chains around impact investing. A lot of those private farmland and private real estate and other things that we invest in are all thinking about sustainability at a major level. So this sustainability trend, whether Tesla will do great in the next 5 years, I don't know. Their valuations are a bit out there, and make what you will of Elon Musk selling big chunks of his stock here lately. But the fact is, every car company worth their salt in the world is coming after them and coming after their market share. So I think that, again, you got to know what's under the hood. So don't just willy-nilly buy a exchange traded fund or a mutual fund that's in the impact or ESG space. Look at the top 10 or 20 holdings. And if Tesla is number one, again, depending on your view of Tesla, just know what you're buying.
Right.
Yeah.
I would like to introduce to our audience, the Honorable David M. Walker has joined us. He's the former Comptroller General of the United States from the Washington, D.C. area. I won't put him in Washington, D.C. because he doesn't like that. It's like he's outside of the Beltway, which makes a difference. And we're joined by Dennis Stearns, who's a billion-dollar money manager actually in the Research Triangle Park area. So he's had the experience of having to manage well over $1 billion. And I guess, David, you attempted to manage over $1 trillion at the U.S. government level. But the problem with the U.S. government, it's a little different than private industry. There seems to be a spending habit up in Washington, D.C. that they can't get away from, and it affects everybody. What is the spending habit going to do to the economy, especially if they pass this $1.8 trillion, not billion, $1 trillion spending bill? Could this have a major impact on the economy in 2022?
Well, first, Dennis talked about sustainability. And we have a number of sustainability challenges. The one that you're touching on is our fiscal sustainability challenge. We are about to hit an all-time record for public debt to GDP. And not unlike the end of World War II, where we were growing the economy much faster than the debt, and therefore debt to GDP plummeted but from over 100% to down around 35% by 1980. We're doing exactly the opposite now. The so-called Build Back Better bill, in my view, would compound that problem because we already have an inflationary challenge. The Build Back Better bill, among other things, would grow government, would increase dependency on government, would expand mandatory spending, does not pay for itself, according to the Congressional Budget Office, includes a number of assumptions that people know on their face are not valid assumptions, that we're going to end up eliminating this program after a year or this other program after 3 years, if you will. It's just totally unrealistic and contrary to history. And so I think, the bottom line is that there's a lot of uncertainty going on right now, which is being reflected in a lot of different ways, including the markets. And in fact, at some point in time, I'd like to talk a little bit about some key economic statistics, as we're entering 2022, and talk about where we are now on a relative basis with regard to these statistics. And then we can debate about where we're going from here.
Okay. Well, now's a good time. What statistics do you have, David?
Well, yeah, let me just, without overloading people with numbers, let me just talk about the bottom line. On GDP growth right now, it's positive, but not as much as expected coming out of a serious recession caused by COVID. Our unemployment rate is down, but that's largely due to lower workforce participation. We have about all-time high number of job openings. Our workforce participation is below average. Inflation is up significantly to almost a 40-year high. Real wage growth is negative. So while wages are going up, they're not going up as fast as inflation. And so therefore, real wage growth is negative. Public debt to GDP, which I mentioned before, is up significantly. It's close to an all-time high and rising. Monetary policy has been very loose, but it's about to be slowed. Interest rates are headed up. It's a matter of how quickly they're going to head up based upon the Fed's actions and other factors. The stock market was up significantly in 2021, but so far it's down in 2022, and there's a significant degree of uncertainty about where we're going. COVID, case rates have increased dramatically because of Omicron, but yet I only know of one death associated with Omicron. And it's debated about whether that death was properly attributed to Omicron. And that was in Texas on Christmas Eve. Consumer confidence is above average, but it's for the past several decades, but it's unsettled. And confidence in Congress and the president are very low. And so the bottom line is that, we need to look at where we are, where we've been, where we're headed, how we compare to others, and to provide more contextual sophistication with regard to some of these statistics that we hear about. And we heard within the end of last week about the job growth numbers for last month, and there was a bunch of spending going on with regard to that. The numbers were a lot less than expected. And yes, we've recovered a lot of jobs from the ones that we lost because of COVID. But again, we still have a ways to go.
Okay. Well, the thing that bothers me, and Dennis, you may want to make sure you're unmuted. Let's see, here you are. Okay. The thing that bothers me is this bill, this $1.8 trillion bill that's being rolled around in your area in Washington, D.C. The total gross domestic product of Pakistan, which has several hundred million people, is 280 billion. Okay. You're talking about spending something that exceeds a lot of the countries that we beam into, David, in just one keystroke. How do they do that? Yeah.
But in fairness, okay, the GDP number you talk about with Pakistan,
Right.
which is hardly a peer to the United States, by the way,
Yeah.
is a 1-year number. Okay.
Right.
The $1.8 trillion number is a 10-year number. Okay.
Right.
Although if you assume that all the things that they want to do actually last 10 years, which is really what their intent is, then it's not 1.8 trillion, you know, it's 3, 4, 5 trillion, depending upon what numbers you go by. All right. Look, here's the bottom line. You know, we've all heard the story. When you're in a hole, the first thing you have to do is stop digging. In addition, you can't dig your way out of a hole. You have to climb out of a hole, which means that you have to make tough choices with regard to not just discretionary spending, which is now less than 30% of the budget, which is part of the budget resolution. You've got to make tough choices with regard to mandatory spending, which is Social Security, Medicare, Medicaid, a whole range of other spending programs, and $1.5 trillion worth of tax preferences, deductions, exemptions, credits, and exclusions, which represent backdoor spending. And ultimately, while our problem is overwhelmingly a spending problem, all right, growth of government, growth in spending, it's overwhelmingly that, we're not going to be able to solve the problem and restore fiscal sustainability and sanity without some additional revenues as compared to the current level. We can debate, you know, how much that ought to be, what the ratio ought to be, how best to achieve it so that it's pro-growth rather than anti-growth. But it's a reality. The math just doesn't work any other way.
Yes, Dennis.
I'm interested in what Dennis thinks too.
Yeah, that's what I'd like to hear.
Yeah. So, well, I was going to ask you a question, but
That's okay too.
but no, I feel like the same situation. You know, I'm not a modern monetary theorist, by the way. So, you know, I'm not buying into that you can just keep doing this with no consequences. And you got to have the underpinnings of innovation and growth to make it work over time. And so I think we have some good underpinnings of innovation and growth in the United States, but they need a lot of work. I mean, you hit on a few of the items that need some buffing and polishing, and I wish the politicians would spend more time on those matters. And I know they do, because, you know, even in the Trump administration, there were individuals working on some of those key things. They just didn't get the priority that perhaps they should have had. Working, I mean, in the early part of the Trump administration, Angela Merkel came to Washington, and she was purportedly, it was to download a lot of the information on the trade schools that they do in Germany so that we could replicate that in the United States. Great idea. It quickly became a bright, shiny object. And, you know, again, some people were still working on those things. And I know a lot of companies that are working on those initiatives. I know a lot of community colleges working on those initiatives. But this one is one that could have taken a federal government stance. Now, the new infrastructure bill, maybe there'll be some money sloshing around. The bill that nobody talks about, because everybody wanted to talk about the second bill. But the infrastructure bill before this second bill that actually got passed, you know, maybe there'll be some money sloshing around for that. But again, I just think priorities are a little goofed up right now. What I was also going to mention here is in 2021, Elon Musk said the number one challenge of our time, wait for it, number one challenge of our time is demographics. And so that's another one, Dave, that I would love your perspective on. the fact that we have shrinking workforce in many countries overseas. The United States, we're barely keeping up with babies and so forth, and the whole issue of immigration, legal immigration, being important to our United States workforce, but then all the concerns about, okay, what downside comes with that immigration? I know that's a that's a big,
well, let me come on that.
Okay.
First, as has been said, demographics are destiny, and it is a major factor that is contributing to our fiscal challenge. Because if you look at Social Security, for example, when I was born in 1951, there were 16 people paying into Social Security for every person drawing benefits. Today, it's down to 3 to 1, and it's going to go down to 2 to 1 within the next 10 years, all right, based on our current course.
Yep.
You take that factor, apply it to Medicare, and then you add the fact that healthcare costs grow faster than inflation and faster than the economy. You have a compounding effect, and those are the two biggest mandatory spending drivers that we're seeing. If you look at our birth rates, we are barely at replacement level, and if anything, those are going down. Immigration is the only reason the United States is growing right now, but there's a difference between legal immigration and illegal immigration. Do we need immigration? Absolutely positively we do, not just because of our financial and economic challenges, because the strength of America is the fact that we're the most diverse country and inclusive country on earth. But there's a difference between on what basis do you immigrate. Most advanced industrialized nations are way ahead of us. They've changed the basis on which that they allow immigration. They don't want people coming here who are going to be dependent upon the state in order to be able to survive. Okay, they are focused more on skills and knowledge with regard to their immigration decisions, while still allowing for a political asylum, which is clearly appropriate. We have a situation now where we need more temporary work permits. We need to separate the difference between permanent legal status and citizenship. Those are fundamentally different, if you will. We need to recognize that, contrary to what the Constitution assumed was going to be the case, that when it was very difficult to get to the United States when the Constitution was ratified, that now it's very easy to get to the United States. We have lots of modes of transportation, and as a result, merely because you're born in the United States shouldn't automatically make you a citizen unless one of your parents is a citizen. Because now we have a situation where we actually provide a tremendous incentive for illegal immigration, because if you have a child in the United States, then with our chain migration, then you have a number of people that potentially could immigrate based on that status. And so, we need comprehensive immigration reform. I'm absolutely convinced that a significant majority of the American people would agree on some of the things that I've just talked about. The problem is the politicians, don't want to do anything about it because it's a big issue in elections. Right. And when the margins are as close as they are, every election is about control. And the difference between whether or not you're in the majority party and the minority party is huge, especially in the House, where basically the minority party doesn't have any rights. A couple other quick things. I'm an staunch opponent to the modern monetary theory because it's contrary to history, contrary to long-established economic principles, based on a flawed comparison to Japan, and in my view is downright dangerous. And my view is right now we have largely been following the modern monetary theory. Okay. Yep. And as you know, one of the things it says is that you don't have to worry about deficits and debt as long as you can borrow your own reserve currency and until you have excess inflation. Newsflash: we have excess inflation. Okay. And so and if we don't end up changing course, we're at risk of having a repeat of something we had in the late 70s. Then that's called stagflation.
Yeah, I will say, Dave, that in recent conversations with a number of public company folks, some of the workarounds that they're doing in their supply chains and supply chain bottlenecks, many of them are now forecasting. Well, first of all, they've been able to pass through inflation to customers, generally speaking, but they do believe now that later in 2022 or 2023, they will have control again over their supply chain and have a better, lower inflation rate for the inputs. So all of that suggests, not every company, but all of that suggests that inflation writ large, maybe we'll end up at a 4% average in 2022. That's still double what we've been.
Still double the target.
Yeah, still double the target. But it won't be, again, some of the worries that everybody has that we're going to be hitting Jimmy Carter years and have hyperinflation.
Well, I do think that there are some transitory aspects to inflation. There's absolutely no question about that. But if you look at the fundamentals, okay, with a combination of fiscal policy and monetary policy, all right, it's not all transitory. The power of compounding is the most powerful force on earth, according to Albert Einstein, okay, who was a pretty bright guy, all right? And the difference between 2% and 4% is big.
It's big. Now, again, I think one of the interesting pieces in my discussion before you came on, I talked about the techno-industrial revolution. And there's a seamy downside to some of that, but there's some huge tailwinds and positives as well. And so much of that technology revolution is deflationary or disinflationary.
Mm-hmm.
And so that's the piece that, and you try to look back to, the first industrial revolution and to other things. And first of all, none of them were similar because this thing is bigger and more powerful. McKinsey says, it's something like 300 times more powerful than the first industrial revolution, which, I live in this space and I'm still not even sure what that means, but it's huge. And so the question is, you kind of got King Kong versus Godzilla here. You got the deflationary and disinflationary elements. And I run into economists occasionally who are still worried about deflation more than inflation, interestingly enough. But then you have these inflationary elements and you have this tremendous pent up demand from the pandemic and consumers with so much cash who are just going to go out there and spend.
Yeah.
Yeah. So what's your take on all that?
I think there's a difference, Dennis, between the short term and the long range. All right.
Yep.
There's no question that there's pent up demand. No question there's pent-up demand. But what I'm talking about is where are we headed with regard to long-term sustainable economic growth?
Yep.
All right. And demographics is a key part of it. That's one of the key inputs to economic growth.
So let me put you on the spot here quickly, Dave. So do you believe the current Biden administration can do the things you just talked about with immigration?
No. But in fairness, the current Biden administration, no other administration has been able or willing to do it either.
Well, maybe my question should have been, do you think any administration?
No, the answer is yes. Yeah, the answer is yes. If you get a president with good communication skills, all right, who will go directly to the American people and leverage the power of the bully pulpit, all right, then I think you can get it, combined with some other things. On the fiscal sustainability issue, I'm involved with a group that may soon bring a suit against the Congress for its failure to call for a limited Article 5 convention for a fiscal responsibility amendment since 1979. And I think the only way that you're going to be able to constrain the size and growth of the federal government and to restore long-term fiscal sanity and sustainability is through such a constitutional amendment.
Yeah.
And the debt ceiling limit has been a bad joke. It doesn't work. It won't work. But what we need to focus on is what really matters. How much debt as a percentage of the economy, such that we have pro-growth policies,
Right.
combined with fiscal responsibility and sustainable policies, so that we can get debt to GDP down to a reasonable and sustainable level, so that we have the fiscal and monetary flexibility to be able to deal with periodic crises without mortgaging the future of our country and future.
And with that, we're going to have to go. We're at the hour. We want to thank the Honorable David M. Walker, the former Comptroller General of the United States, Dennis Stearns, CEO and founder of Stearns Financial Group, billion-dollar money manager. We'll see you all next week on Economics with the Honorable.